Let's talk about commercial real estate. It's an area of the market that many property investors will periodically look at. Indeed, you might have already looked at investing in commercial real estate. However, as many of you will have realized, not all areas of commercial real estate are created equal. You've got things like retail, you've got things like hospitality, and you've also got office blocks. Furthermore, the geographic location will make a huge difference. For example, an office in a CBD is very different from a restaurant in a residential hub that has many people that are working or living around it. There's a lot of heterogeneity in the space. Furthermore, there's a lot of heterogeneity across countries. For example, the situation in Sydney could be very different from the situation in Hong Kong, for example. And this means that we can't just take a one-size-fits-all approach to commercial real estate. But it is, as an investor, something that you might want to consider at least looking at, because the yields, at least in theory, can be higher than residential real estate. Furthermore, it's typically less of a political football when it comes down to regulations and cost of living and the like. After all, most people do want restaurants to exist, and a restaurant is typically not seen as undermining housing affordability, and therefore it is less of a political issue every time we come up for an election. And it's one of the reasons that I've personally done commercial property, albeit in mixed-use areas. And I've personally found commercial real estate to be rather good. However, when I'm personally looking at these things, there's a couple of things that I happen to like to look out for. For example, I want to look out for things that have decent yield, hopefully a tenant in place that is actually relatively stable, or at least a property that has had a track record of being able to keep tenants. And you want to make sure that the actual yield you are realistically going to earn on a net basis is sufficient to cover your cost of capital. So in my case, I'm often looking at areas such as the Inner East in Sydney, which is an area where there's a residential hub. There's also some business being done there, although it isn't quite as much as, say, in the CBD. But certainly there's a lot of business around, a lot of people around, and there's therefore demand for various pieces of property. Furthermore, when I'm looking commercial, I'm often focused on buying the land rather than an office. And if it was strata titled, often something with actual street frontage, which gives more flexibility. And if you're interested in finding out more about my investments or getting property advisory, well, you can contact me and I'll leave some details in the description below for you to be able to do so. And again, if you're interested in investing alongside me, well, of course, I'll include some details to my fund that I manage as well. But nevertheless, in the topic of commercial real estate, I recently spoke with TRT World News about commercial real estate, albeit focusing particularly on Asia.
The Financial Stability Board is warning that the $12 trillion global commercial real estate sector is facing mounting risks, ranging from high debt burdens and liquidity mismatches to scant data on how bank and non-bank exposures interlink. Now, offices and retail commercial mortgage-backed securities are sporting default rates of 12.6% and 11.2% respectively. Banks holding $8.5 trillion of commercial real estate exposure could be sitting on a ticking time bomb. HSBC's designated 73% of its $32 billion Hong Kong commercial property loan book is at a high level of risk. It was only 30% last year. Office vacancies have now hit a record low, 19%. Prime office rents are down more than 20% since 2022. HSBC set aside $1.1 billion for the second quarter, with $400 million specifically tied to real estate losses. Jones Lang LaSalle Incorporated is a global real estate services company. It estimates that, millions of square meters of global office space across 66 key markets need extensive upgrades of risk becoming stranded. The price tag, $933 billion US dollars to $1.2 trillion over just the next 5 years. Morgan Stanley Capital International reports signs of stabilization. Institutional investors like Blackstone and Norges Bank Investment Management Fund are selectively deploying capital in gateway cities, but the rebound's patchy. Some Asian cities are nearing pre-pandemic occupancy levels, with vacancies remaining elevated in North America and Europe. So it's a complicated situation. Let's find out more now from Mark Humphrey-Jenner, Associate Professor of Finance at UNSW Business School. Welcome to you, Mark. So regulators and banks have got to manage the systemic risk linked to failures in commercial real estate markets worldwide. I mean, there's a lot to lose. How are they going to manage that risk?
Well, firstly, thanks for having me. And in reality, in terms of managing the risk, it's probably better to do so before things really get out of hand. After all, when you start to get mass defaults and things start to cascade, and there are fire sales, it creates a bit of a downward spiral. At the moment, the regulator's best choice at the moment is really going to need to be getting the banks to recognize their doubtful debts and potentially their looming defaults in a proactive manner so they can properly capitalize themselves to manage that buffer. So they come up with an actual plan to avoid having to engage in fire sales. And it appears some banks, particularly in Hong Kong, are trying to do that proactively, not necessarily through regulators, but they are effectively trying to avoid defaulting companies too early so they can try to manage through cash flow problems. But it's going to come down to trying to get on top of that risk management piece. And regulators, if they're looking at it right now after things have gotten too late, well, there's only so much they can really do in terms of actually just getting the recognition of these things and reducing the amount of allocation to that sector going forward.
What's the cause of the problem here? Why are we seeing so much real estate losing value? Is it just companies can't afford to pay for the properties? Not enough people are going to the office anymore? How would you assess the cause of this?
Well, there's going to be a few things, and not all commercial real estate is created equally. For example, I personally own commercial real estate in Sydney, but it's primarily in sort of the restaurant and hospitality sector and is mixed use as well. And that sector does okay. But if we're looking at commercial real estate in the office space, well, that's been very much struggling, in part due to people not working at the office as much. And not necessarily just people working from home all the time, but when they're working from home, say 2 to 3 days per week, you end up with office space being required and or less demand for things like actual physical offices so much as share plans, which reduces the amount of demand. And we're seeing that really across most segments. There's been a small recovery in some markets, but in reality, demand for offices has decreased. And along with that, demand for retail in some locations has also decreased. So seeing a reduction in demand, which is a problem. Furthermore, when there's that reduction in demand and therefore a reduction in cash flows, you get less retrofitting of the offices, making them less attractive to potential tenants. And those potential tenants can look at other options, potentially not in the CBD, depending on the business they are actually looking at running. Furthermore, as people are more working from home, there's a shift away from CBDs to some extent to other locations that might be more cost effective. So seeing several factors. In terms of the debt piece of this, you're seeing some private debt lenders engage in rather risky practices. Now, again, to be clear, much like with commercial real estate, not all private debt lenders are created equal. So, for example, there's one in Sydney called Rixon Capital, which is very good, but it isn't lending to these risky property loans, which have sunk many of the private debt lenders. And when they're lending to risky property loans, it creates a portfolio risk effect. And it's been reported anecdotally, at least, that some of the private debt lenders are effectively funneling their own property developments, which themselves can amplify that risk. So we're seeing several factors really pile together to worsen the situation.
You're talking about risky lending. I used the phrase ticking time bomb earlier. I mean, if this all turns south, I mean, has this got the potential for another financial crisis?
Well, we do have a bit of a ticking time bomb aspect to this. So let's just look at the loan maturities, and this will vary a lot across markets. But we can just look at places like Hong Kong, for example. It's been reported there'll be about $4.2 billion worth of loans maturing, or at least bond maturities emerging in 2026, which is forecast emerging in 2026 is going to go up to 7.2 billion rather from 4.2 billion this year. Now, what that tells us is a rapid increase in bond maturities over time. And the companies are going to need to, that is the property developers, are going to need to refinance that debt. And this is where we're going to get a bit of a problem. We're seeing more and more bonds maturing, but as lenders realize that there's more risk, they're going to be less prone to refinancing that debt. For example, say you've got these $4.1 billion worth of loans maturing this year, but there's $7.2 billion maturing next year, in 2026 rather. Well, you start to realize, is it actually wise to refinance all of these things? Or do you try to force things toward an orderly wind down? And lenders are going to be thinking through this. Now, whether it's a ticking time bomb is really going to depend on the market, but it's something that if it gets out of hand, could certainly create a bit of a downward spiral in property prices and also a downward spiral, therefore, in risk management for many of these lenders.
I mean, there's also an assumption that things will improve, that companies will need offices in the way they used to in the past, and that people will return to the office. I remember several years ago learning about the fact that the automation of cars, self-driving cars, might completely change the locations in which people will work. They might live much, much further away, work in different places. I mean, it's not guaranteed, is it, that people will return to the office?
Certainly. And there's definitely optimism amongst commercial real estate that people will need to return. And many companies are trying to force a return to the office, at least for 3 days per week. Now, that hasn't always gone down well with staff, particularly when those staff were hired on a work from home basis and are being forced into the office. Certainly, many of those staff might feel as if they were hired under false pretenses, which creates a problem for mandating the returns. In some markets, there's a push away from return to office. To give you an example, the Victorian government in Australia had been trying to enable all workers to potentially work from home, something that is on legally shaky ground, but nevertheless, they're trying to do that. Now, what that suggests is we won't necessarily get that return to the office and therefore the upshot in commercial real estate in the office type space. That said, we will see a small growth. There could be some silver lining with some of these offices being converted into residential, which has been talked about in some markets, but it's only suitable in some areas and not in all areas. And it certainly costs money to turn an office into an apartment. It's not instant, nor is it cheap to do, and there are regulatory hurdles. Regulators could potentially enable that, but it's not clear that that is going to occur in a quick or a cheap way, which does amplify that risk. Now, there's been talk that perhaps you could pressure governments to force people to return to the office, but when the premise for forcing people to return to the office is to underwrite commercial property developers, that's hardly a good reason, i.e., forcing people to go back into the office to ensure a commercial property developer doesn't go bankrupt is not exactly going to carry favour with the workforce. Nevertheless, we're probably going to see growth over time, just not necessarily growth back to where we were instantaneously.
Mark, wonderfully explained. Great to have you on.
So there we go. We've got a bit of an overview about commercial real estate. The office space is facing challenges. Lenders are also facing challenges, and this is going to create some difficulty borrowing for commercial real estate. Because lenders are not necessarily going to be able to distinguish all areas of commercial real estate, whether something is good, bad, or otherwise. And they're not just going to take your word for it about what the potential yield is. They're going to want some actual evidence of this, which means that if they are winding back their allocation to commercial real estate, and you are looking at investing in commercial real estate, you need to be prepared for issues being able to raise capital for that. You also need to be prepared for not wanting to have to refinance it continually, at least not refinance it without having paid down some of the principal so you can refinance it on an easier basis. I.e., you want to make it easy for a lender to actually want to lend to you, and that's not always the case with commercial real estate, particularly in the office space. And many developers are finding this out at the moment. Nevertheless, commercial real estate can be of interest if you happen to buy it correctly. And if you're interested in getting in touch with me, well, you can do so, and you can also check out my fund, which I'll include a link to in the description below. But otherwise, thanks a lot for tuning in, and hopefully this video has been informative to you.